In the middle of last decade, 2005-2006 timeframe, private equity firms were sitting on tens of billions of dollars more than they had expected with the low interest rates, and they had to put that money to work. And so many of them discovered that retail was an area that could be interesting for them. The idea was retailers generate a lot of cash for their sales, so there's a lot of cash flow there, but also that these retailers are sitting on a lot of real estate that could be sold and could be a backstop against any difficulty that the companies had. PE's playbook when it comes to retailers is to take companies that are underperforming and then fix them up a little bit, make them leaner, take out some costs, have them pursue some new business avenues that they might not have thought of and that they could do well in, and then ultimately sell it at a profit either by reselling it in its entirety or by taking it public again in a stock market listing. The benefit of being private is that it allows a company to make very large business decisions that might be hard for the markets to swallow or to accept. For example, if you are restoration hardware, when you're private, you can say, well, we're going to get out of X many malls and we're going to focus on our own stores in these key markets, and you're not going to have Wall Street freaking out on you. And so being private allows a lot of companies to fix themselves in relative peace and quiet. The retail industry in the last couple of years has gone through what some people call an apocalypse, but what we call a reckoning. And an often cited culprit of these problems are private equity firms. The vast majority of the big bankruptcies that we've seen in the last couple of years in retail are companies that were owned by private equity firms. And so a lot of people hold them responsible for those companies' failings, ultimately because they had too much debt and lost their agility and were starved of cash at a time that they really needed to invest to adapt to the Amazon threat and also other threats. Just in the last year, you had mega blowouts like Toys R Us and the Sports Authority. And these are companies that were so loaded down with debt and had to pay so much money on interest and also had to meet very stringent profit targets that they were unable to compete. Toys R Us's problems were that a lot of its stores ended up being drab and boring, and that's really not the environment that parents want to shop for toys in with their kids. Toys R Us ended up getting outmaneuvered by Amazon, Target, and Walmart, among others. And companies like the Sports Authority didn't navigate the downturn in sports goods sales very well either because they took forever to build up their own website. The idea of a private equity is to borrow money when you buy the company, and the expectation is that the company will grow and perform well, and then that way the debt serves as a leverage that increases their returns. However, as we saw in the last couple of years, what can also happen with all that debt is that it handcuffs a company and makes it more difficult for it to adapt to new realities.